This year is the 40th anniversary of the 1973 oil embargo. And that, I think, is important because it marks a clear turning point in modern economic history. And also for us as energy economists, there are some lessons to be learned from that episode. Just to recap, 1973, major Arab oil producers imposed an embargo on major consuming countries around the US in the context of political disputes about supporting Israel. Prices more than tripled. We had big shortages and long queues in major oil importing countries. Oil importing Western countries were plunged into a deep recession. And the question is, was that just a passing episode, or did it change some things for good, and which are these things? It did change some things for good, most notably in energy markets. You see the share of oil in global energy consumption peak in 1973, and ever since its share in the global fuel mix is declining. 73, it reached almost 50%, now it's a little bit above 30%. Oil is the only fuel which has such a clear structural break, and of course oil at the same time was also in energy terms the most expensive of all fuels. And that high price led to oil share declining. Importantly, this doesn't mean that the consumption of oil has declined. It just meant that the fuel consumption of other fuels grew faster. Now the reason for this was, and the decline wasn't equal across all sectors in the economy, oil became concentrated in transport, where it's still dominant, because it doesn't face competition from other fuels. And it got crowded out everywhere where it did face competition from cheaper fuels, most notably in power generation, where it's now down to 4%, and has been replaced with cheaper coal, cheaper natural gas, but also in industrial production, where it has been replaced by natural gas to the extent possible. So the fuel share continues to decline on the back of these high prices, and oil continues to specialize. On the economic side, there's also an interesting impact of all this. The impact in 1973 and then again 1979 of very high price rises was fairly obvious. The world went into a recession. Nowadays, we have the highest oil consumption ever, not as a share, as I said, but on absolute levels. And again, very high, record high oil prices. But the world has become much less vulnerable to oil price shocks. And the reason is that over these past 40 years, the share of oil has declined. And therefore, if I measure oil as a share of global GDP today, it's much lower than it was in the 1970s. And therefore, again, the world generally is more capable of dealing with high oil prices than it used to be the case 40 years ago. The reaction to the embargo in the 1970s was largely to impose price controls in consuming countries. And it was these price controls, more than an actual shortage when you look at production consumption numbers, which caused the long queues and the closed gas stations. And I remember when I was a kid and we couldn't play football on a Sunday because there was a ban on driving on Sundays and these kind of things. And the price controls proved to be highly ineffective in either weaning the world off oil or in sort of allocating it more effectively. And I think hasn't been tried again on a large scale ever since. So that was one big lesson there. And the other lesson, of course, is that how flexible energy markets really are in the long term when you think of the massive replacement oil has experienced in many sectors where it used to have a prime role to play when it was cheaper.